Whew. All right, let's dive into a really fascinating chapter in Canadian financial history, the story of the income trust. This is the tale of an investment vehicle that was, for a time, the talk of the town. But then, almost overnight, a single government announcement threw its entire future into question, forcing a whole industry to basically reinvent itself on the fly. So what happened? Let's get into it.
To get a sense of just how big this was, just look at this number. At their absolute peak back in mid-2006, Canadian income trusts had a market value of over $200 billion. We're not talking about some niche investment here. This was a massive, central part of the Canadian market. The stakes, as you can imagine, were incredibly high.
And that really brings us to the core question we're tackling today. What exactly were these income trusts that had everyone so excited? And how could one single policy decision from the government spark such a massive sector-wide crisis? This is a story all about that delicate and sometimes explosive dance between corporate strategy and tax law.
Okay, so to really feel the impact of the change, we first have to understand what came before it, what you might call the golden age of income trusts. We need to look at what made them so incredibly popular in the first place.
So here it is, the secret sauce. An income trust was basically a structure that acted as a special kind of pipeline. It let a company pass its earnings directly to its investors, the unitholders, without having to pay corporate income tax on that money first. You can think of it like a toll-free highway for cash flow moving directly from the company to the investor's pocket. It was an unbelievably efficient way to deliver returns.
And boy, did this idea catch on. At first, it was a huge magnet for everyday retail investors. People looking for a nice, steady income stream for their retirement. But it didn't take long for the big players, the institutional investors and mutual funds to jump in, which just poured fuel on the fire. And what started out in just energy and real estate, well, it exploded into almost every other sector of the economy. By the summer of 2006, you had 245 of these things making up a huge slice of the Canadian market.
And then, everything changed. It was Halloween night 2006, of all times. The federal government made a surprise announcement that would completely rewrite the rules of the game and really signal the end of an era for income trusts.
The government brought in something called the SIFT tax. Now, the official line was that this was all about leveling the playing field. But if you look at it from the government's perspective, they saw a problem. This income trust boom meant more and more profits were shifting outside the traditional corporate tax system. That meant a serious erosion of the country's tax base over the long term. So the SIFT rules basically slammed a new tax on these trusts, making their payouts look a lot more like regular corporate dividends. And just like that, in one fell swoop, the main tax advantage that had built this entire $200 billion industry was gone.
This slide just lays it out so clearly. On the left, you've got the before picture. The trust was a flow-through, no corporate tax on the way out. And on the right, the after picture. They were now on the hook for corporate-level tax, just like any other company. The shelter that made them so unique had vanished.
Now, the government didn't just flip a switch overnight. They were actually pretty smart about it. They set up a transition period. Right away, the announcement stopped any new companies from becoming trusts. But for the ones that already existed, they got a grace period until January 1st, 2011, before the new tax kicked in. And this is key, they were given until the end of 2012 to convert themselves into a regular corporation without triggering a massive immediate tax bill. This timeline basically created a window several years long where every single trust had to make some very tough strategic decisions.
So imagine you're running one of these trusts. This new reality hits you like a ton of bricks. The very structure that made your company successful is about to become obsolete. You are, quite literally, standing at a crossroads, and you've got to figure out which path to take.
When you boil it all down, there were really three main options on the table. Option 1, just do nothing, stay as a trust, and start paying the new SIFT tax. Option 2, you could try to sell the business, merge with someone else, or maybe take it private. But honestly, the market conditions were terrible for that at the time. And then there was option 3, which turned out to be the most popular path by far, convert back into a traditional corporation.
And this is where we get into the real nuts and bolts of our explainer. For all those trusts that decided to convert, the big question was, how? Well, the government laid out two primary, tax-friendly ways to do it. You can think of it as the official conversion playbook. The first method, and a very popular one, was called the share exchange. And just like the name says, it was all about a direct, clean exchange of securities between the trust's investors and a brand new corporation set up for this very purpose. Okay, so let's walk through how this worked. First, lawyers create a brand new corporation. Let's just call it NewCo. Next, the investors, the public unit holders, directly trade in their old trust units for new shares in NewCo. This was designed to be a tax-deferred rollover, so no one got a big tax bill. And finally, once NewCo owns all the old units, the original trust is simply dissolved within 60 days. It's a really clean and direct way to transfer everything into the new corporate structure.
But here's the real prize for using this method. The biggest advantage was the ability for the new corporation to tap into the old trust's tax history. Because NewCo technically owned the trust for a moment, it could inherit its valuable tax attributes, things like past losses that could be used to shelter future corporate profits from tax. That was a huge financial incentive. Okay, now for the second play in the book, the share distribution method. This one's a little different. Instead of a direct swap with investors, this was more of an internal reorganization, a shuffling of assets that ended with a distribution out to the unit holders.
So let's trace the steps on this one. First, the trust itself creates a new subsidiary, our NewCo. Then the trust moves all of its operating assets down into that new subsidiary. And for the final step, the trust is wound up, and in its last act, it distributes the shares of NewCo out to its unit holders. So at the end of the day, they now own the corporation directly.
Now, this is the absolute key difference. In a share distribution, the new corporation never actually owns the old trust. Because the ownership path is different, this method typically meant that NewCo could not access those valuable tax attributes from the trust's history. And honestly, that was often the single biggest factor in deciding which of the two methods to use.
But picking between these two tax methods, that was really just one piece of a much, much larger puzzle. The decision to convert, when to do it, and how to pull it off involved a whole web of interconnected business, legal, and financial questions. It was anything but simple.
I mean, this image really captures it. The trustees who had to make this call were facing a monumental decision. There was no one-size-fits-all answer. Each path had totally different consequences for their investors, for their debt, and for the entire future of the company. It was a true strategic crossroads.
And this was basically the checklist they all had to run through. First, timing. Do we convert early and get it over with, or do we wait and squeeze out every last drop of the tax advantage? Then, investors. Our unit holders are here for steady income. How are they going to feel about a new corporate dividend policy that might be less generous? And then you have the legal minefields. Does this conversion count as a change of control that could trigger clauses in our debt agreements or major contracts, forcing us into costly renegotiations?
And finally, the sheer cost of it all. As this image suggests, every single trust had to do this delicate balancing act. On one side of the scale, you have the massive direct costs. We're talking armies of lawyers, bankers, and advisors, not to mention the huge indirect cost of management's time and focus. And on the other side, the potential future benefits of being a corporation again. This was a multi-million-dollar calculation for every company involved.
The story of the Canadian Income Trust is just such a powerful case study. It reminds us that so many of the business structures we think of as permanent are actually built on a foundation of tax policy. And that policy can change. It leaves you with a really interesting question to think about. What structures out there today that seem totally normal and permanent are maybe just one single legislative change away from facing their very own great conversion?